Log on, tune in, find out. Another good idea from Cambridge.
Well, welcome to the second Sir Richard Stone annual lecture, which is organised under the aegis of the Centre for Research in Microeconomics in the Faculty of Economics here. CREMEC, that is the Centre, instituted these annual lectures to honour Richard Stone's contribution to the University of Cambridge in particular, and not least when he was served as Director of the Department of Applied Economics, probably in its most productive first period, 1945 to 1955, but also to his, in recognition of his contribution to economics more generally. Now, a most important aspect of Richard Stone's research in the area of consumer behaviour was the central role he accorded to economic theory in informing the construction of empirical economic models. And what I mean by that is the necessity for a theoretical understanding of economic agents' decision-making. The Stone-Geary utility function is an obvious example of his efforts in that regard. I mentioned this particular concern of Richard Stone since economic agents' decision-making constitutes a major research interest of today's Richard Stone lecturer, Professor David Laibson. Perhaps I could say a few things about David before introducing him to you. David is Harvard College Professor and Robert I. Goldman Professor of Economics at Harvard University. He's a leading international scholar in behavioural economics with research interests that span psychology and economics, experimental economics and neuroeconomics, and has published widely in the leading international economics journals such as Econometrica and the American Economic Review. David, of course, is well known to UK audiences. As you may recall, he gave the 2009 Royal Economic Society Frank Hahn Lecture and the 2007 Lionel Robbins Lectures at the London School of Economics. So let me now invite David to present the second CREMEC Sir Richard Stone annual lecture entitled Asset Pricing, Natural Forecasting, Asset Pricing and Macroeconomic Dynamics. Thank you, David.
Okay. Thank you very much for the invitation to come here today. I'm honored to give this lecture. Obviously, Richard Stone's work has influenced all of us, but as a person who spent my professional life focusing on consumption, I've been particularly attentive to his contributions. I want to talk today about a new topic for me, which is trying to think about what just happened to our world economy and whether the things that are happening to us during this 3-year period are part of a broader set of regularities that characterize economic activity, at least over the last 50 years for which we have good data. I'll be talking about natural forecasting, asset pricing, and macrodynamics, and this is joint work with 2 doctoral students at Harvard, Andreas Fuster and Brock Mendel, who you should keep your eyes open for. They're terrific. So Kindleberger is the person that we most associate with kind of characterizing the long history of financial crises. And when he thinks about financial crises, he tends to emphasize that there was some initial impulse that was good, really, truly good impulse. There was then a period of rising prices. Maybe things got out of hand during that epoch. There was then rising leverage, consumption that responds, investment that responds. The economy really begins to heat up. People become very, very optimistic. And then, of course, expectations falter. People decide maybe it wasn't as good as we thought it was. We see then deleveraging, and we see everything sort of reverse. There's a banking crisis, maybe there's a recession and depression. I want to begin to take apart some of these mechanisms and bring to bear a psychological kind of approach to thinking about these dynamic processes. I'll be focusing on the middle 3 categories in red and talking about bubbles, in particular talking about non-rational bubbles. And obviously, there are rational and non-rational bubbles in the literature. I'll be making a case for the latter category. So classical economists are usually pretty critical of those who advocate for the non-rational approach. They argue that, first of all, there are good rational cases when you can have a bubble. So Tirole is famous for making that argument. They also argue that often we look ex post and say that was a bubble, but of course it was just hindsight bias. We knew after the fact that the news ended up being not so good. And it wasn't that there really was an irrational bubble. It was simply that with the benefit of hindsight, we conclude after the fact that asset prices should be lower. So I don't want to suggest those arguments are wrong. I just want to offer a different approach today. I'm going to make the case for bubbles that are partially not so rational. And I'm going to explain macrodynamics with those bubbles. And I'm going to offer a parsimonious theory that kind of ties all this together. So just to kind of set the stage, you think about the kinds of phenomena that we'll be discussing today. Here's the bubble in Japan in the late 1980s. And you can see the kind of extraordinary movements in equity prices that occurred at this time and the drop-off that they've never recovered from. In this case, you don't even see the peak because this is year-end data. The Nikkei got to over 50,000 before plummeting to 10,000 and staying there forevermore. Here's the ratio of total Japanese net worth to GDP, and you can again see the same trailings. Well, recently we had the dot-com bubble, and I think one of my favorite examples of the pretty clear irrationality in that case is what happened at 3Com and Palm. This is work by Lamont and Thaler. And what they showed is that for a period of time that lasted about 3 months, even though 3Com, a large, major company with a lot of profitable lines of business, owned almost all of Palm, the price of Palm, now Palm, of course, is that unsuccessful phone company that was basically just sold and is barely staying in business. Palm, at this time, was worth a lot more than the company that owned it, implying that all of the profitable lines of business in 3Com actually had negative value. So they calculated the stub value of all the other lines of business in 3Com, this enormous profitable company. And for a period that lasted about 3 months, from March to May, you can see that the rest of 3Com, when you subtract out the price of Palm, which was owned by 3Com, Palm had done a little IPO, so there was a market price for Palm. Subtract out that value, and you're left with a per share value for 3Com of minus $30 a share. So it's events like this that make me think we need to think harder as economists about the possibility of irrational bubbles. Now, the current crisis has many different explanatory factors. There are many different arguments for what's going on. There's the savings glut that Bernanke has emphasized. But in work that I've done with Johanna Mullerstrom, another doctoral student at Harvard, we've actually shown that there was no worldwide increase in savings when Bernanke claimed there was, in fact, a savings glut. That's just an assertion he made, believe it or not, without validating it, an assertion that the whole world believes, but turns out to be just empirically wrong. In fact, it's not clear whether it was the savings in Asia that drove high asset prices in the West, or whether it was high asset prices in the West that drove the trade imbalances that Bernanke was trying to explain. Here's data from my work with Johanna, and you can see here, if you put housing price appreciation over this bubble period on the horizontal axis and trade imbalances on the vertical axis, you see that the countries that had large housing price appreciation ran big trade deficits, and the countries that had small housing price appreciation, low housing price appreciation, ran big trade surpluses. So it's not at all clear that this is, in fact, I think it's not a worldwide savings glut. Instead, I think it's actually probably a channel leading from housing price appreciation and other asset price appreciation to consumption booms, and those drove the trade imbalances. Obviously, if you think you're rich, you import a lot of stuff, you run a trade deficit. That's the US story. In Germany, by contrast, another Western country, they didn't have a housing bubble. They didn't run a trade deficit. They didn't think they were rich. They, in fact, ran an enormous trade surplus. There are rational bubble stories by authors like Caballero and his collaborators. But those stories explain how a bubble can arise. They don't predict that these bubbles would go away all of a sudden. So I think those stories are also kind of on the rocks. There are agency problem stories, but in other words, banks were selling this garbage to other people, and the banks were kind of ripping off the counterparties they were selling this stuff to, these collateralized debt obligations, for example. But we saw the same housing bubble in countries that didn't have any of these exotic products. So go to Ireland, for example, and they had no collateralized mortgage obligations. They had no exotic mortgages, and yet housing prices were even more extreme in Ireland. So I'm going to emphasize today, well, let me give you some evidence on why I don't think it's agency problems. This is a report that came out of Lehman in 2005, near the peak of the housing bubble. And this was Lehman's internal kind of calculations about whether housing prices would go up or go down over the next period of 5 or 10 years. And you see that Lehman says that there's a 15% chance in 2005 that housing prices will appreciate 11% per year over the next 15 years. And they think there's a 15% chance that housing prices will appreciate 8% per year over the next 15 years. And a 50% chance that appreciation in housing prices will only be 5% per year over the next 15 years. And then a 15% chance that housing prices will be 0% for the next 3 years, and then 5% thereafter. And only a 5% chance, according to Lehman, that housing prices would experience a quote-unquote meltdown, in which case they would decline by 5% for the next 3 years, and then rise by 5% thereafter. So this was what Wall Street believed. And it wasn't, of course, just Wall Street. It was also the regulators of Wall Street, notably Alan Greenspan, who repeatedly chose to embarrass himself by forecasting again and again and again that everything was fine. So I don't think there was a conspiracy of people who got it and wanted to sell the garbage to others. There were a few people who got it, particularly late in the game in 2007. But at the peak of the housing bubble in 2006, most people, not most, overwhelmingly on Wall Street, the belief was these prices are relatively robust, they're not going away. So I'm going to focus today on non-rational bubbles, and I won't be able to convince you that that's the right story, but I want to show you some evidence and some models to begin thinking about these issues. So let's talk about the US bubbles, again setting the stage. I'm going to focus on the US because that's what I know best, and that's in many ways the heart of the problem. There were a lot of good fundamentals, so Kindleberger would be happy. The crisis begins with really honestly good news for the world economy and for the US economy in the late 1990s. Here's a list of those things. There are many others. And what do we see? Well, let's first look at equity prices. So we see the price to earnings ratio historically. This is Shiller's wonderful price to 10 years inflation adjusted earnings ratio, which has been a great predictor of when asset prices are out of line. And you can see here the roaring 20s with a peak value of about 32. And here's the peak value in the IT bubble of nearly 45. But the IT bubble does not go away in 2001 and 2002 when tech prices crash, because we end up with a new steady state level, or at least temporary steady state level, that exceeds 25. So this is the level of the level of the price to earnings ratio in the period 2003 to 2007. And you can see that we're still at a level that by historical standards signals extreme excess valuation. So I want you to begin by thinking about the situation in 2007 is not just a housing bubble, but also a kind of hangover bubble in the equity markets. Here's housing prices, two of the most extreme examples, Las Vegas and Phoenix. I assume most of you have seen this picture. This is the Case-Shiller data, and you can see this remarkable burst up and then burst down, 2003 and then 2007 to 9. Now, the remarkable thing that should make you very skeptical of the claim that this could be rational is that in many of these markets, notably Las Vegas and Phoenix, these cities have endless land on their peripheries on which to build new housing. So here's Phoenix, and you can see here this, how many of you, I don't know, have you been to Phoenix? So Phoenix is this green area here, and it's just irrigation. It's a desert. They pump the water in. And Phoenix has a great highway system, so lots of highways leading out to the periphery and highways that circle the city, so you can get anywhere very quickly. From the center of Phoenix to the periphery, it's about 8 miles. And how is it possible that the prices of housing in Phoenix could double when you can build a new house on the periphery for half the cost of the price that just doubled? So here's a quick kind of undergraduate version of Phoenix that again emphasizes the kind of impossibility of this being an appropriate fundamental. We have supply, we have demand. In the short run, supply is vertical. We got our equilibrium. For some reasons we'll come to in a second, demand increases. Prices increase by a lot. They basically double in Phoenix. But supply responds because the long-run supply curve in Phoenix is perfectly flat. You can build a house cheaply on the periphery of Phoenix. All you got to do is buy the lumber. The land is basically for free. It's desert. So over the long run, the price of housing has to fall, and the long run here is about 3 years, has to fall from here to here, falling in half. But of course, the problem is that once the price of housing falls, this short-run outward shift in the demand curve reverses, and we end up, well, let me show that on the next slide, we end up with this, with the demand curve shifting back to the original demand curve, and so we end up with the price way down here. So we end up with the price of real estate in Phoenix going from, 400,000 back down to 200,000. And the people who bought here, you got to wonder, what were they thinking? And we know what they were thinking. They were thinking what the people at Lehman were thinking, which is, for some reason, miraculously, trees grow to the sky, prices are going to stay where they are or increase. And there we have the deadweight loss, housing that's built, even though the actual social value is below the cost of the new housing that was constructed. And here's the question, why would you buy your house at $400,000 when you could buy it 3 years later at $200,000? Or why would a mortgage company originate that loan? So here's the total index for US housing, and you can see here the run up and then the run down. In aggregate, the US housing market fell by 30%, 33% during this period. Now, there's a lot of stories about what might be going on here, maybe something was special, maybe, there was some unusual historical event. This is data from Schiller, and you can see that home prices do this, but there's nothing kind of shocking about interest rates or about the population, about building costs. We don't have any kind of, explanation that uses fundamentals to justify these shocking movements. Now, you can also think about the aggregate US economy and think about total household wealth and divide it by GDP like I did for Japan earlier. And you see here this, again, remarkable break from historical norms. Here's the ratio historically, and then we have the tech bubble. We come back to Earth partially, and then we have the housing bubble with the residual equity bubble, and we reach levels that are unprecedented in the post-war experience. This is as far back as the data goes. Now, that's even making it look good. If I added government debt to this, and of course, like Greece, we actually owe people that money. Government debt is going to make this line here that comes back down fall much further because in essence we've sold a lot of our future prosperity to foreign lenders in the course of this enormous spending period as we've been kind of struggling to fight back the recession. Okay, so what am I going to do today? I want to, all this is, basically so far journalism. I've told you the story of what happened with a bunch of pictures and a bunch of data, but economists rightly ask, well, what can we do with this? I mean, is it going to be hand-waving? Is it going to be, storytelling? Or are we going to actually be able to work with models, have discipline, be rigorous? I'm going to try to move in that direction, and we're just getting started on this, and I hope you'll help me think about where to go next. So I want to offer a formal model of non-rational bubbles. I'll have some micro foundations. We'll generate testable predictions. We'll look at those predictions in the available data. And again, the goal is to study non-rational expectations with a parsimonious and disciplined generalizable framework. I don't want to throw out a lot of parameters. I want to keep things very simple so that we can do economics the way everyone else does economics, writing down simple models and testing them. Okay, so there'll be 2 building blocks for the model I want to discuss today. The first building block is what we're calling natural forecasting. So we're going to kind of build a model of how an economic agent intuitively kind of comprehends the world and makes predictions about the future. And you'll see that this nests rationality. So rationality will be a limit case in this model. That combines with a kind of natural characteristic of the world, which is innovations have a hump-shaped effect on economic activity. And that's just a fact. I mean, we'll document that empirically. So when something happens in the world, it happens in a way that comes in, it goes up, and then it comes back down. There's a little bit of mean reversion. I'm then going to kind of take those two ingredients, one of which is kind of our assumption, and the other of which is an empirical fact, and then embed them in a very simple stylized model of the economy, leaning heavily on consumption dynamics. So I think it's appropriate that this would be in the Richard Stone lecture. I'll then kind of look at what the model delivers, and we'll see that it corresponds in interesting ways to the actual historical record. I'll then kind of contrast what we get in this equilibrium with what we would see in a world where agents made perfectly rational forecasts, and there's a kind of night and day difference. And then we'll talk about extensions if we have time. Okay, so I'm actually going to open it up for questions while I talk, but if we have too many, I'll just ask you to let me keep going. But if you have any questions, please, let me know, and we'll also have time at the end for questions too. Okay, so related literature. I've kind of been amazed at, on the one hand, what I want to say today, I think many economists really feel in their gut is wrong, because I'm going to lean heavily on non-rational beliefs. And yet, when you look at the literature, there's a lot of people who over the last 20 or 30 years have made contributions that are related to some of the ideas I'll discuss today. I want to talk quickly about a few of those contributions. So Barsky and DeLong have a model of irrational forecasts of dividends. Now their model is really strongly irrational. Our model is a lot more rational than theirs, but they're thinking along the same lines. Bernardsey has a model, has data where he shows that people are highly prone to extrapolate recent experience when forecasting returns in company stock. Campbell and Schiller, as I already told you, had these remarkable pictures where they show that price to earnings ratios are highly predictive of future returns in equity markets. And that's going to be true in the model that I'll show you as well. James Choi has a model of extrapolative beliefs where he's trying to explain the equity premium puzzle. In my work with James and Bridget Madrian, we find positive feedback in investment when people do well. They double down, implying that they think that historical returns that are high predict future returns that are high. Cutler, Paterba, and Summers had documented in a series of papers, that's just one, negative autocorrelations in returns, though with low enough magnitudes that you really can't reject the null hypothesis of a random walk, but still, you see all these negative correlations out there. Laporta, using microdata, I'm just picking out some of them. I could have 4 slides like this. Shows that growth expectations have insufficient mean reversion. So when a company does really well, it appears that the people who are forecasting that company believe it's going to keep doing really, really well going forward and price the asset accordingly, leading to, of course, excess negative returns going forward. There's, of course, the famous work by Leroy and Porter and Schiller in trying to document excess volatility in stock prices. That's been controversial. There's Latow and Ludvinson's work showing that wealth to consumption ratios negatively predict future returns. When wealth gets high relative to consumption, that predicts remarkably robustly negative returns going forward. Piazzesi and Schneider have a paper on extrapolation in the housing market. Previtero shows that people don't buy annuities when the stock market's doing well, and they do buy annuities, which are bonds, when the stock market's doing badly. And Tortorici shows that individual households, when surveyed, have extrapolative beliefs when it comes to predicted unemployment rates in the future. So there's actually a kind of, I think, very large and growing body of literature documenting beliefs that seem not to be so rational, or seem not to be perfectly rational. So what are we going to do? I said there were 2 key ingredients. The first key ingredient is natural forecasting. We're calling it natural forecasting. So what do we mean by that? Simple model. Let this operator n be the natural forecasting operator. And when I forecast a change in some variable in the future, I'm basically going to say that the natural forecast, by that I don't mean what you cognitively say your forecast is. I mean your gut instinct. This is just the gut. This is not your answer to the exam question. This is what your gut feels. Your answer is, well, the growth tomorrow is going to be phi times the growth today, where phi is tied down by historical experience. So phi is not pulled out of the air. Phi is going to be a fixed parameter which is driven by the historical relationship between lagged growth and future growth. So phi is not a free parameter. It's a parameter which is estimated by the data, pinned down by the data. And now, the answer you give on the exam, when you're asked by your friends, by your coworkers, by your spouse, what is your forecast for economic activity in the future? Your answer is theta weight on your natural gut forecast and 1 minus theta weight on the rational expectation. So if theta is equal to 0, you're 100% rational. You give the completely rational answer in predicting what will happen in the next period. But if theta is greater than 0, you're going to put a little weight on that gut. And the gut, as you see, is not exactly the right model. Though we'll see that the gut is not crazy in forecasting many macroeconomic activities. So even if you put full weight on the natural forecast, you wouldn't be night and day wrong. So again, the notation, N is the natural forecasting operator, E is the rational forecasting operator, E hat is the behavioral forecasting operator with a convex combination of the two. Phi is not a free parameter, it's just calculated on the historical data, so that's handed to us. Theta is the free parameter. We're going to set theta to a half because we don't know any better. The model nests rational expectations, theta 0, and you can think of theta as the index of irrationality between 0 and 1. Okay, so let's say some more things about natural forecasting. Again, this is the gut component that combines in a convex combination with rational expectations. So natural forecasting I presented up here as the natural forecast of the change in the variable is phi times the lag change, and that's equivalent to the natural forecast of the change between date t plus tau minus 1 and date t plus tau being equal to phi raised to the power 1 plus tau times delta times the lag between t minus 1 and t minus 2. So basically you kind of have this theory of the world. In essence, your theory of the world is an ARIMA autoregressive integrated moving average 110. So it requires, why is it natural? It requires minimal memory. You've just got to keep in mind the change that happened last period. It has no free parameters. Notice phi here is tied down by the historical data. So, you know, my hands are tied behind my back. When I write this down, I've got no free parameters in this gut model of the world, or this model of your gut. It nests a random walk, so if the underlying process is a random walk, you'll estimate phi to be 0, and you'll be exactly right in your forecasts. And it also nests, I think, the kind of natural physical theory of what happens in the world, which is frictionless momentum. When you think about an object moving in space and you're going to predict what's going to happen from the moment you're observing it to what's going to happen in the future, frictionless momentum is phi equals 1. So it nests the kind of natural physics of movement on the surface of the Earth. Okay. Now, so that's the first ingredient, natural forecasting. What about the second ingredient? This is just a fact about the world, an interesting, robust fact about how dynamic processes evolve in economies that we measure. They tend to have hump-shaped impulse response functions. And I think probably most of you know what I mean by that. In other words, when there's an innovation, the innovations, which here is just an innovation of 1, tends to grow for a while and then come back. And it could come back so it ends up above its original impulse level, or below its original impulse level, or all the way back to where it started. So it doesn't matter for our purposes which one of these three it is. It just matters that the world is characterized, and I'll document this in a second, by dynamic processes that have this hump-shaped impulse response. Okay, so to say that more formally, Andrew Harvey is not here, is that right?
Unfortunately.
Okay, so Andrew Harvey, I was at LSE for 2 years, and Andrew Harvey taught me econometrics. And let me say to you, he was a fantastic teacher. I read all of his books lovingly twice. And then I shot myself. No, they were fantastic. And everything I know about time series econometrics, I learned from him. So I'm grateful to you, Andrew Harvey. So I'm fearful that I got something wrong and he would correct me. I'm glad he's not here. So here's the real world, an ARIMA P1Q. Here's the lag operator, the autoregressive lag operator, and here's the moving average lag operator. We invert it. So now we have an ARIMA 0, 1 uppercase Q, and Q might be infinity. And all we mean by hump-shaped impulse responses is that the impulse responses are characterized by a bunch of positive coefficients in the MA representation, and then a bunch of negative coefficients in the MA representation. But, you know, whether you think about it this way or whether you think about it as up and down, doesn't matter. Same exact idea. So now let's look at some data. So let's characterize macroeconomic time series, and we're going to estimate them a bunch of different ways. Let's first estimate them using the gut model. So the gut model is the model, it will always be the case, the gut model is in blue, in ARIMA 110. So in ARIMA 110 says, I think that tomorrow's change is equal to a factor times today's change in expectation. So if you take the data and you estimate in ARIMA 110, you end up with the blue line here. But now let's try to get a little more sophisticated and get it right. Do it the way the rational actor would, by enriching the MA representation. So let's estimate an ARIMA 014. So that's 4 moving average terms. Or an ARIMA 018. That's 8 moving average terms. Or an ARIMA 0112. 12 moving average terms. Now we can't go above that. Well, we can, and we sometimes try it, but there's not enough data to go above that. And what happens when because we're working here with basically post-war US GDP, quarterly data. We only have that data from the 40s, you know, to today. And in most countries, the data isn't even any good back to the 40s. You've got to kind of go to the 70s to get good quarterly data. So what do we see? Well, when we do it the gut way, the natural forecasting way, we get impulses that grow and then stop. So good news comes, and you think it's going to not only stick, you think it's going to stick at an even higher level. You are very optimistic after a good shock, because the world's going to be even better than the shock initially took us to. But as you add more of these terms, you get the hump shape coming in. And you get that with GDP. So here's the ARIMA 018 and the ARIMA 0112 up and then down. And you get that with unemployment. Here's the blue line is what you would get naturalistically, just again estimating the ARIMA 110. But as you add more and more terms, you get up and then down for the ARIMA 0112. And again, it looks like for unemployment, the more terms we add, the more and more it goes up and then all the way back to where it started. For log real earnings, this is NIPA earnings, national account earnings. And you see here with the ARIMA 110, this is earnings to capital. So it's like capital earnings in the economy. You see with the ARIMA 110, the naturalistic forecasting, it's up and then it basically sticks. But as you add more and more terms, it becomes up and then down. Yeah, so these, absolutely, and that's a great point. So the standard errors just blow up. So there's just not enough data. Yeah, you don't. So, and this is going to come on a later slide. Everything I'm going to tell you about today is driven by your priors. So what I'm going to show you is there's a plausible prior that is the world that I'm describing. But I can't convince you that's the right world because we don't have enough data. In fact, you'd need, you know, thousands of years of data, or at least 1,000 years of data, to be able to know whether the world is the world that we usually study or the world is the world that I'm going to show you. They're basically indistinguishable in terms of time series econometrics. The problem is that if policymakers have priors that the world is the classical world, they're going to make a lot of mistakes. And I want to just introduce the alternative and warn people, you can't tell the difference. And when you look at least at the point estimates, my world looks a lot more reasonable than the classical world. And I'll show you those point estimates later. But I mean, you see the point estimates here. But you're right. There should be there are big standard errors here. And so we don't know what the long run outcome is. But we can show you the point estimates. And then here's S&P returns. So what happens when there's an innovation in the stock market? Well, basically, if you estimate the ARIMA 110, the gut model says that good news is going to stay. In fact, it's going to be a little bit better. In fact, it's going to go up a little bit more in the future. But when you estimate the ARIMA 0112, you learn that, in fact, the good news, meaning the stock price, is not going to persist at the high level. It's going to come back a little bit with the big standard error. Okay. Now that's just, this is just a reflection of the old regressions that Cutler, Paterba, and Summers ran. There is robust negative correlation in stock returns, but I should say there's whenever you estimate it, in whatever country, go anywhere in the world, you estimate negative correlation with big standard errors. Okay. So let's interact the two. Let's take the two ingredients that I want you to think about, naturalistic forecasting and hump-shaped impulse responses, and marry them together and see what we get. So here's an example. It's an example I'm going to keep coming back to. I'm going to embed this in a model later. Let's think about a world where the data generating process is an ARMA 2.0, and it's a stationary process, so all good news eventually goes away. So I get a good earning shock. I'm happy for 5 years, higher earnings, but in the long run, I'm basically going to go back to my old earnings level. But individuals are using natural forecasting. So they're regressing the change in earnings on the lag change in earnings and estimating this parameter phi. Now we can actually solve for that analytically. One of the nice features of everything I'm going to show you is we have analytic solutions for these simple illustrative cases. And if you solve it, you find that phi estimated with this equation, even though the data generating process is this equation, phi is given by this expression here. So let's take a look now at the forecasts of agents in this economy, and let's compare rational forecasters who basically completely get it. The rational forecasters exactly know the right data generating process to behavioral forecasters who are using a convex combination of their gut, which is this equation, and rationality, which is this equation. So the behavioral folks have this kind of, intuitive combination of the two. So let's first look at the rational folks. The rational folks have theta equals 0. They put no weight on naturalistic forecasting. They're exactly right. So the impulse response for the rational folks is up and then down in the world I just showed you. For the behavioral folks, if they have 100% gut, if they just are going with their gut and they don't have any weight on the rational side, they look like this, the red line. And then the convex combinations are all the points in between, and you can see a few of them up there. Now the first thing I want to emphasize is these lines aren't that far apart at 4 quarters. If you're a behavioral guy making this mistake, you're thinking about it the red way, and you should be thinking about it the blue way, you're not that far off. And by the way, if you kind of looked at the historical data, you wouldn't be able to separate the two models. The data just, there isn't enough of it, again, to know which of these two models is right. So they're both plausible candidates. And the forecasts aren't that different. The problem is that there are night and day differences at long horizons. So this is a 4-quarter impulse response function. This is 4 quarters of what's going to happen down the road. This is 4 years down the road. Now, Wall Street forecasters don't make forecasts like this. No one's forecasting GDP, not no one. I mean, it's typical forecasts are, next quarter, next year, not 4 years down the road. But you can see that 4 years down the road, the forecasts from these two intuitive, from the theory that is perfectly rational to the theory which is a combination of the two makes a big difference. So the rational forecast in this example is theta equals 0. And the intuitive forecast, pure intuition, is theta equals 1. What we're going to do is we're going to assume that agents have a kind of half weight on each. Agents are here, theta equals 0.5. So they're, on the one hand, half rational, which means they're pretty far away at long horizons from where they should be. Okay. So now let's tie all of this together with an illustrative model and kind of look at how it plays out. So here's the data generating process that I showed you a moment ago, but now I'm going to add a constant to it. So there's some background level of earnings that is not moving around stochastically. That background level of earnings is mu. I'm going to introduce a labor tree which offers a non-stochastic labor earnings every period of y. I can make that stochastic. It's not going to change the results. I'm going to study quadratic preferences to keep things closed form and simple. I'm going to study the limit case in which the quadratic curvature goes to 0, so I can use risk-neutral asset pricing, again, to keep things simple. The risk neutrality doesn't matter for the issues that we're discussing. It's just going to add, it's going to change the premia, the stationary premia in the economy. I've got a discount factor of delta, and I'm just doing standard separable utility discounting. exponential utility discounting. Now, I'm going to introduce some slightly strange features, again, to kind of capture what we see in the economy. I'm going to let my agents borrow from abroad. So when they get really good news, or when they get news they think is good, they're going to go on a spending spree and fund it by borrowing from abroad to raise consumption or to raise investment. So here's their dynamic budget constraint, where B is the total liability to foreign lenders. So the total net liability to foreign lenders. So if B is negative, then you're lending to abroad. So your total liability in period T plus 1 is equal to your consumption in period T plus the gross rate of return R times your total liability the previous period minus the dividends that you got minus your labor income. To make things simple, we're going to set delta, the discount factor, multiplied by the gross rate of return R equal to 1. And we're going to assume that the domestic capital stock is owned exclusively by domestic agents, so that foreigners don't own U.S. houses and U.S. agents don't own foreign houses. Likewise, foreigners don't own U.S. factories and U.S. agents don't own foreign factories. I guess I should say England rather than, so it would be like English people don't own Welsh factories, sorry. I wonder how many people I just insulted. Why do we assume that? Well, we need to create a world in which the capital shocks aren't diversified. So that when good news comes to the domestic economy, it leads to a domestic boom in consumption rather than kind of the whole world economy getting an epsilon slice of that good news. Now, why is it kind of a reasonable assumption? Well, there's home bias. We know that in the data. For some bizarre reason, domestic agents seem to insist on holding domestic assets even when they can hold foreign assets. There's moral hazard. You can't, when you rent a house, you trash it. There's adverse selection. The kind of people who rent houses trash them. And there's expropriation risk. If a foreigner owns capital in a country, it is often the case that the domestic government finds a way to expropriate that capital by regulating the foreigners more aggressively than they would regulate domestic agents. And then we're going to add natural forecasting with weighting parameter theta. So that's the whole model. Oops, like I got a little problem there. So basically, it's a very stripped down, simple, kind of classical model with one exotic feature, maybe two exotic features. We're introducing natural forecasting with weight theta, and we're also creating a situation where only domestic agents own the domestic capital stock. Okay, so we can solve, I don't know where these boxes came from, but ignore these little boxes. We can solve for consumption. Consumption is just the annuity value of your wealth, where your wealth is calculated using your behavioral expectation. So I used, I know where it came from. It must be a font issue. There should be a hat above the E. This is a behavioral expectation. So it's not a rational expectation. It's not a natural expectation. It's a behavioral expectation, hat here. What's a behavioral expectation? It puts weight theta on your natural expectation, your gut, and weight 1 minus theta on your rational expectation. So let's now solve for those objects. What is your natural expectation? Well, the natural expectation of your dividend stream is...
Wouldn't this system give you a lot of feedbacks would affect the fact that people have behavioral expectation would then affect the process generating the D, and therefore rational would be different?
Okay, so that's a great point. I've shut that down in this version of the economy by making it a tree economy. So it's a kind of class, I should say, it's a Lucas tree economy where the dividend stream is exogenous flows of earnings and the labor stream is exogenous flows of earnings. But you're quite right that it'd be interesting to introduce investment, which would then make the earnings process endogenous. I don't think it would change. The reason we left it out is we think that would take away all the ability to do analytics. We'd have to lean much more heavily on just solving for these functions numerically, and I don't think it would change the results. But it would be interesting to know how endogenous investment and endogenous dividend streams kind of create a new fixed point. This is a paper for the Journal of Economic Perspectives is having a symposium on what we're learning from the macro crisis. And so it has to, it's supposed to be simple stuff. But I think an interesting follow-up paper would be one in which we computationally solve for the economy that you've described. So here's what natural forecasting implies. This is what agents who rely entirely on their gut would believe would be the discounted value of their future dividend stream. And again, phi here is the parameter in the naturalistic forecasting function that I showed you earlier. It's solved using the observed historical process. So it's tied down by what you would estimate if you observed the historical process and estimated the wrong equation. And then the rational forecasts are given by this system here. These are the two relevant roots. And then you can end up with this expression for the rational set of beliefs about future, the rational discounted future earnings. And you might worry, there look like there's some imaginary numbers here. There are, but multiply it all together and solve it out, and you end up with real prices. So the imaginary bits behave themselves. Okay, so let's calibrate this very simple model, which is meant to show you how much you can get without even assuming much in settings like this. So we're going to have a quarterly model. We're trying to match up with quarterly US data. So R is 1.015. So we're assuming a kind of 6% real return in our markets. Alpha is recall that this is the dividend process. So alpha is the factor that multiplies the first lag. And we went to the historical national income accounts and we estimated this process, and we ended up with an alpha basically equal to 1.45, a beta equal to minus 0.5. We set sigma, which is the standard deviation of the innovations in the dividend process, in the earnings process for capital, equal to 0.035, matching the historical level of volatility in US equity markets. Mu is the average level of capital earnings. Y is the fixed level of labor earnings. So we set 0.33 to match the historical capital income share, which is a very constant ratio. And then we have this free parameter. So I only have one free parameter in this system, which is the weighting I put on the naturalistic forecasting. Everything else is just given by historical data. So let's now show you simulations. Don't be scared by this slide because I assume you can't even read it, but I'm going to first tell you about the structure of the simulations, and then I'm going to show you the correlation tables in bigger fonts. But here's the structure first. So we're plotting here the, oops, what was that? Oh, the foot. That was pretty good. So we're plotting here the correlations between a variable here and future variables here. So it's t versus t plus tau, t versus t plus tau, t versus t plus tau, and here's tau. So this is consumption at date t versus returns at date t plus 1, consumption at date t versus returns at date t plus 2, etc. So now let me show you each of these sets of results in greater detail. Here's the correlation between consumption growth and equity returns and future equity returns. And obviously, in a classical model, these should all be exactly 0. In this model, they're not 0 because people are making asset price mistakes. And in the data, you can see they're pretty robustly not 0. This is estimated on, we're using the Latau-Ludvigsen data set, the most recent version of their data set. So this is data from 1952 basically to 2009, quarterly data. And the reason it starts in 52 is because that's when the wealth data starts from the Fed. So you can see that there's a bunch of negative, in the data there's a bunch of negative correlations, and they get bigger as you get further away from the present. Here's a minus 0.21, a minus 0.13. Then they kind of come back down. So low to high to low. What do we see in our simulations? Same pattern, low to high to low. You'll notice that the data in this column, the autocorrelations bounce around a lot, which is to be expected. We only have about 200 observations. Whereas in the simulations, this is a 5,000 period simulation. So not surprisingly, this pattern looks a lot kind of more regular than this pattern. Now what's happening in this data? You see something that's very intuitive. When there's a high level of consumption growth today, that predicts that the economy might be in one of these boom episodes. But in this economy, those boom episodes kind of, in some average sense, are false booms. The economy kind of gets ahead of itself and then comes back. So consumption growth today implies there's a chance we're in one of these, a small chance we're in one of these false booms, and that's going to predict negative excess returns in the future. Now the predictions are very weak. I mean, you can see these are correlations that are, minuscule. The R-squared here would be less than 1%. So it's not like someone could go out and exploit this very easily. But there is this pattern linking consumption growth today implies a slightly greater likelihood of negative excess returns over the next 10 quarters. Yes?
So the data is about has twice the effect of the simulations. Are there constants in the simulations that can be adjusted to?
There are, and I'm going to show you that later. So what we did in this first pass is we just fixed blindly theta. We haven't searched for the right parameters. We've just kind of threw out theta equals a half. I'm going to show you later another version of this model with an additional parameter that that actually brings these two columns and even into closer relationship. But this is kind of, this is not us trying to fit the data. This is just us setting theta to a half. Okay, now here's the next relationship. Correlation between return at date t and return at date t plus tau. Now again, in a classical model, in this kind of classical model, the return should be orthogonal. Historical return should not predict future returns. But in the data, you see what people have documented both in the US and across countries. At the frequency of a quarter, there seems to be some momentum out there. That's the positive 0.09. But then you get a lot of negative coefficients as you go forward after that. And that's true the world over. So what do we see in our data? A little bit of momentum in our data, in our 5,000 simulated periods, a little bit of positive momentum, and then again this big lineup of negative long run, of negative correlations. Good news today, good returns today predict negative returns in the future. Now why is that? Again, it's the pattern whereby when good news hits the economy, these natural forecasters believe that that good news is going to be highly persistent. In fact, they believe that an innovation of 1 today will be a persistent innovation that's even greater going forward. They'll actually, I take that back. They believe that it'll persist, but they believe it'll persist more than it will actually persist. It's not that they think it's going to get bigger and bigger. It's that they think that the good news today is going to have a much greater level of persistence than will actually be realized in the underlying economy on average. So that means that when there's a good innovation today and returns are positive, that has a very weak prediction that returns going forward are going to be a little bit negative. Now again, you couldn't exploit this stuff. These correlations are so close to zero that there's basically no R-squared there. So if someone wanted to believe in the classical model, they could easily kind of reject these kinds of correlations if they had 50 years of data only. With 5,000 years of data, obviously, or 5,000 quarters of data, you could make that restriction, you could make that rejection. Okay, here's the next relationship. What about the correlation between the wealth to consumption ratio at date t and returns in the future? So again, let's compare the data from the US economy to the simulations with theta equals a half. So in the data you see this robust pattern of negative correlations. And they're getting kind of, pretty large, or larger I should say. I mean still a correlation of 0.1 is a R squared of 0.01. They're getting larger. And you see the same, kind of similar pattern over here in the simulations. Actually, here it's remarkably close. And that's very intuitive. When you get good shocks in this economy, you raise consumption a little bit because only a third of your wealth is linked to your assets. The other 2/3 of your wealth is linked to your labor income. So a good shock raises your wealth a lot and raises your consumption only a little bit. So this ratio goes up, W over C, and again, that predicts negative excess returns going forward. you're likely, on average, to be disappointed over the next 5 years or next 10 years. So in this case, it's 10 quarters, not 10 years. We would extend this further, but we can't do it for the data because there's so little data in the post-war US experience. Now here's the last one I want to show you, which is the correlation between the wealth to consumption ratio at date t and future consumption growth. In the classical model, consumption growth should be IID, consumption should be a random walk, so we shouldn't see any kind of predictable patterns in consumption growth. But in this model, we see this pattern whereby when W over C is high, well, what happens going forward, consumption tends to fall. Now, most economists, when they think about W over C being high, they think, well, that means C should catch up and rise, catch up with wealth, right? If C is some kind of, sticky variable, it's hard to adjust my house or it's hard to adjust my car or my fridge overnight. If I get rich, I adjust them slowly. So economists, when they first began studying wealth to consumption and correlating it with returns, began to think that, or rather W over C and correlating it with consumption growth, they began to think, well, high ratios of wealth to consumption today should predict consumption growth in the future as consumption catches up with wealth. But in fact, in the data you see negative relationships. That's the Litow and Livingston data, or fact. In fact, when W over C is high, that predicts that consumption is going to fall in the future. Now, why would that be? Well, no one has a story in the real world, in the world of classical economics, but in this model, it makes good sense. What's happening is when W over C is high, you're in one of these boom epochs. You're in one of these momentary periods when people think they're really rich. Asset prices are too high, they're above fundamentals because they're using natural forecasting. And so, in fact, what's going to happen is consumption is going to be also too high. And when W over C is high, that predicts that consumption is going to fall. We see that in the data and we see that in the simulations. Though you can see a certain kind of disconnect in the pattern here. Here it goes from minus 0.07 to minus 0.23, whereas here it goes from minus 0.14 to minus 0.11. We're going to fix that as we tweak the parameters later. Okay. So let me summarize so far. So improvements in fundamentals cause overreaction in asset prices. Consumption also rises too much when fundamentals improve. Everything kind of overshoots. Then asset prices come back and consumption comes back as everyone realizes we overdid it, we got too excited. But if you lived in this economy and you believed in classical economics and you only had 50 years of data, you could not reject your hypotheses. The correlations that I'm showing you, correlations like 0.1, you could easily believe in the classical model with this data because the standard errors are much bigger than the point estimates with 50 years of data. Now, one thing that we haven't done yet that we plan to do is we plan to kind of leverage our data by looking at all these moments simultaneously, and that's going to give us a little more power. But at least if you looked at moment by moment, you couldn't reject the classical hypothesis. And that's a point really that Larry Summers made in '86, not with this economy, but more generally thinking about alternatives to a random walk in asset markets. Now, I've shown you what the model predicts, and I've shown you the data that matches those predictions. What I would like also to have you think about is the counterfactual. What if I took everyone in this economy and I made them all rational? So that instead of having a theta weight of 1/2 on their gut, they had a theta weight of 0 on their gut, and they just completely used rational forecasting. What would their behavior look like? Well, the volatility of stock returns would fall by 75%. And the volatility of consumption would also fall by about 75%. So this is an economy that's characterized, in theory, by a great deal of excess volatility. Now, there's a bunch of extensions. I tried to show you the simplest model that I could. I mean, it's meant to illustrate the ideas in the most transparent way possible, showing you don't need a lot of bells and whistles to get these sensible predictions. But we can't help ourselves. There's a few bells and whistles that we're going to add later, and two that we've already added, one I want to show you today. So obviously, I built a dividend process that was completely stationary. That's kind of ridiculous. surely there's some persistent component in the true data generating process. So we should add that in. We have. It doesn't change the results. We should also add stochasticity to labor income. We know on theoretical grounds it's not going to change the results. But we should do it just to kind of, to put all the pieces together. We also are thinking about adding quantitatively meaningful risk aversion. We anticipate that won't change the results either because it's just going to kind of affect the risk premium, but not these correlations. And finally, what will change the results, and what I do want to show you now, is adding a mechanism for delayed adjustment in consumption. A critical feature of the consumption data in the real world is that consumption growth is autocorrelated. And it's autocorrelated not just at a 1-quarter lag, which you would expect from time aggregation, but it's autocorrelated at a 2-quarter lag and a 3-quarter lag. So there's a lot of predictability in consumption growth. Now, why is that? It's because when good news hits the economy, we can't all adjust our lifestyles overnight. I mean, I buy a car every 10 years. So if I got rich, I would buy a nicer car 5 years from now when my current car breaks down, or a nicer house, or a nicer whatever, many, many years in the future. So we need to think about a world, I think, where consumption growth is kind of partly driven by my current annuity wealth and partly driven by where I was last period. Now, I apologize. I neglected to add a slide here that puts that in formulaic terms. The formula that we're going to adopt is that your consumption level is equal to an alpha weight, or let's not use alpha, that's a parameter that's already in the model, is equal to a phi weight on, or that's also in the model, a psi weight on your consumption last period, and then a 1 minus psi weight on your annuity wealth. So that's very simple. Consumption is equal to a psi weight on your consumption last period, that's reflecting all the stickiness, and a 1 minus psi rate on your annuity value of wealth. And let's see how everything changes. So first let's look at the correlation between consumption growth and returns. And you can see here, this is getting back to your question. And by the way, the weighting here, psi is 0.4. So it's a 0.4 weight on historical consumption from last quarter and a 0.6 weight on the annuity value of your wealth, including human capital. So basically what that does is it purifies the consumption process a little bit. It makes consumption a much better reflection of whether historical returns have been really good or really not so good. It kind of makes consumption a better indicator of whether we're in a boom or not in a boom. So it's going to raise the correlations that I've shown you pretty robustly across all the different figures that I've shown you. And it's also going to change the tilt of some of these autocorrelation functions. So let's first look at the correlation between consumption growth and the return at date t plus tau. So does consumption growth today predict returns tau periods in the future? And the answer is, here's the data, you've already seen that, and here's the old simulation, I've faded that out, and here's the new simulation adding this habit term. So you can see here that the numbers are getting bigger, and they're better matching, in some sense, the average values over here. And that's, again, this purification effect. What about the correlation between returns at date t and returns at date t plus tau? Well, they're not affected by this. All we've done is changed the consumption policy. We haven't changed asset pricing at all. So what you had before in simulations, you have again. And this is a pretty good fit. What about the correlation between the wealth to consumption ratio and the return at date t plus tau? Well, here's the old simulation data, here's the new simulation data. In this case, we've actually pumped up the correlations through this habit a little more than we should have, but that's what the model generated. We now have values of about minus 0.18 when we should have values of about minus 0.14. They come into better kind of sync in the latter half of the autocorrelation vector. But again, these have big standard errors, so I'm not sure I would make much of the fact that we're different here, but they are different. And what about the correlation between the wealth to consumption ratio and consumption growth? Here we're going to make a big improvement. Now, because people have these habits, when you get a shock in wealth, it takes a while for consumption to catch up. So as a consequence, we end up with a rising vector of a rising set of magnitudes in terms of these negative autocorrelations. The first thing that happens after a shock is, while wealth is high and on average falling because the future is not as good as you thought it was going to be, consumption is still on the upward path trying to catch up with this higher level of wealth. So we end up with a low level here, and again, this is low here relative to the values that we get in here. So it goes from minus 0.07 to minus 0.25, minus 0.27. So again, we get low to high in the data and low to high in the simulations. So now we're doing a much better job of fitting the patterns. So the one piece that I think belongs, we haven't searched across all the parameter space. All we did in this setting is we fixed theta, the weighting on your gut, to 1/2, and then we introduced this alpha parameter, both because we think ex ante it belongs in there and also because it makes the autocorrelation patterns map better between the data and the simulations. Okay, so let me conclude and then we'll have time for questions. So, I know that this won't convince anyone who believes profoundly in the classical model, because nothing I've shown you, at least moment by moment, has a small enough standard error to reject the classical model. So really what I want to argue is this is an alternative to consider, not one that is overwhelmingly favored by the data. We believe that if we combine the moments in a follow-on paper, we will be able to make that kind of inference, but we certainly haven't made it in this analysis. We acknowledge that there's an element of ad hocness here. We've introduced a behavioral parameter theta, and we set it to 1/2. But we want to argue that we're not playing fast and loose with a lot of free parameters. We have one free parameter, theta, and classical models also have their degrees of freedom. But we acknowledge that that free parameter is an advantage, and it is in some sense out of thin air. The analysis here is portable to other settings, so if you like the natural forecasting model, you can apply it to any other setting you want. We tried to build a model that had that portability feature, and I think that makes a model testable because it doesn't just apply here. We believe that you can take that piece of the model, that key ingredient, take it anywhere else, plug it in, and test it. And so we hope people will do that, and I'm sure that they'll find ways in which we're not right, but that's good. The model generates lots of testable predictions. I've just shown you some of them. I mean, that generates every feature of the economy is affected by these forecast errors. We did pretty well with the moments that we looked at. We looked at autocorrelations of asset returns, co-movement of wealth, asset returns and consumption. And the classical model does badly on all these features. Basically, it predicts no predictability for returns, no predictability for consumption growth. Here, it delivers a pretty good picture of all of those dynamics, even without the habit, even when you set the habit to 0. But obviously, much work remains to be done. This is just scratching the surface. There's questions about policy and about kind of how a Bayesian would approach this. If a Bayesian puts equal weight on our model and on the classical model, I think they should be pulled towards our model by this evidence. But if the policymaker is a classical econometrician, she won't be able to reject the classical model. And it's kind of interesting. What should the policymaker do? Should they be a Bayesian or not? We're just beginning this line of work, so we welcome.
Does that imply there are no policy implications? That is, Ghana, you said there were any.
Well, no, there are enormous.
Language the policymaker might understand.
So if you're a policymaker and you think of the world classically in terms of econometrics, and you say, is there enough data to reject my classical model, the model that, say, you believe everyone's rational? I would say there's barely enough data to reject. Maybe there's not enough data to reject the classical model. But if you're a policymaker and you don't have that strong prior, and you instead say, look, I'm going to put equal weight on naturalistic forecasting as a plausible hypothesis, and on rationality as a plausible hypothesis, then you'll be pulled towards the naturalistic forecasting model of the world. And then there's enormous policy implications. You should lean against bubbles. I mean, we should think about all the unintended consequences, but you should lean against bubbles. You should worry about asset prices that get very high. When lots of good news comes in, you might want to kind of tamp down on the economy before the recession starts. There's all sorts of things that would follow from this framework, but you have to be a Bayesian to even get the ball rolling because the data is so limited. And this is the,
Where do you stand on this? Would you lean against bubbles?
I'm so unqualified to opine on that, but yes, I would. If some terrible thing happened and every other economist died and I had to make the decision, I would lean against bubbles. But I'm not an expert. This is a stylized model. I believe the model. I think this is the way the world works, and I would lean against bubbles. But I'd be pretty nervous leaning strongly against bubbles because. No, I don't have that position. No. I would lean against bubbles, but I would lean against them as they got big. I have another paper that argues that welfare costs of bubbles are highly convex. We've kind of quantified it. And so a bubble of 10% isn't a big deal in terms of human welfare. A bubble of 20% or 30% or 50%, that's when the costs get enormous. So if I were in charge, which if the world is rational, they'll never do, I would lean against bubbles of 25%. That's when I would start to get pretty aggressive as a policymaker. But you'd have to, how would you know there's a bubble? Well, you'd have to use the metrics that are here, like the Campbell-Shiller ratios. That's how I would think about it. Common sense. When the price of housing in Phoenix got 25% above its old level, and they were building houses like crazy on the periphery, that's the point where I would get very nervous as the city of Phoenix, or as the governor of Arizona, or as the Federal Reserve chairperson. But I wouldn't get nervous by a 10 or 15% movement, because who knows? Maybe that's just some real fundamental. Okay, so that's it. So I think that's it. Yeah, that's it. So questions? Yeah?
How can we determine what data is?
Well, you could easily do a method of simulated moments estimate of theta, which is what I would recommend in this case. We'll probably eventually get to that. So you write down this model. You have one free parameter. You have dozens and dozens of moments. You have standard errors on all those moments. You pick the value of theta, or your computer picks the value of theta that minimizes the weighted difference between your vector of simulated moments and your vector of empirical moments, where the weighting matrix is basically the inverse of the variance-covariance matrix. Our guess is that when we do that, we're going to come up with a pretty small standard error for theta, and I promise you, given the data that we've seen so far, it's very unlikely theta will be anywhere near zero. So that's the exercise that I would pursue.
You have a very crude, way of describing the classical world. This is a very specialized type of classical world. Because you could have these guys in Japan or other places, they're buying these things because they think they can sell it before, and this could be quite rational.
Rational of the person planning to sell it, but not. But if there's someone.
Rational, and the next person is buying it because he's selling it to someone else. And there are lots of models of rational models that can, are consistent.
Right. So do you mean a Tyrolean rational bubble? That's perfectly plausible.
I don't mean just Tyrolean. There are lots of different models.
Okay, but I don't mean Tyrol in the sense that literally his model. I just mean a rational bubble in the sense that there's an asset, and
you know that this bubble is going to burst, but you don't know when.
Right.
And you might ride it.
Yep. So I accept that that's
that's just one example.
Yeah, that's a plausible model. I don't think that that's what's happening in the world, but I agree that mathematically one can write down that model.
I think I can see what you're doing, but I mean, one could have done it by heterogeneous agents. I mean, in the sense that it just seems to me maybe a story with a heterogeneous agent, which people have looked at informed and uninformed trades. I'm not saying you're following exactly that path, but it just seems to me it is not something outside the scope of even classical econometrics. You know, we do forecast combination. I mean, we do a lot of this. There's a huge literature out there, but no one in the world believes that one model is the best model, right? I never thought of that 30 years ago. I don't think I believe that either. So I think this argument is that you really need to allow for more heterogeneity of beliefs and have different, even if you're a single individual, why would you want to put your eggs in one basket of a model? It could be this or maybe many, many other models, right? So basically, that makes the story coherent, but it's very difficult to bring it to the data. That's what it just seems to me, as you pointed out, I mean, why this particular model? There could be many other ones. You can combine theta 1, theta 2, theta 3. I mean, you try to test for one of them, but then I come and say, why should we want theta? There will be different specification for different groups in the society. It's just my problem is that at the end of the day, there could be many, many stories given the weakness of the data that even if you're a Bayesian, at the end of the day, you could have many Bayesians having different beliefs. So I know this dichotomy that if you were a Bayesian, you could do different. That doesn't even, I don't even begin to understand it, because you've got different priors, you could have different data, different models. I don't see why that dichotomy somehow resolve the problem of decision.
So when I said that, I was thinking about a horse race between the model that I've written down here with theta 0 and the alternative theta greater than 0. And in that case, the Bayesian will end up with an outcome. But you've made a great point, which is, look, there's a zillion models out there that one could ultimately estimate, and it's going to be very hard to know, where we want to be in that space. And the problem is extraordinarily complicated in terms of this Bayesian updating. So and the models that you described with many different types of agents and many different types of beliefs and all sorts of convex combinations, in principle, I like that. In practice, I think we do need parsimony. Parsimony's been useful in science, and so I would just push you to take that 12 parameter or 50 parameter model and try to shrink it, because for reasons that are beyond my capabilities to understand, simple models have turned out to be more successful in science and social science. But the idea that this is an illustration of a broader class of models where agents have beliefs that are convex combinations of different models. I like, we're on the same page, and you should give me the papers that you're talking about so I can add them to our growing list of citations, because that certainly belongs in the list of influences that we're trying to funnel into this way of thinking about the world. I mean, the key thing is that it does matter a lot if you believe the models that you and I are describing, whether it's one homogeneous agent who puts weight on 2 beliefs, or 20 types of agents who put weight on 80 beliefs. It's still a very different model from the rational expectations model that has guided a lot of decision making, in recent decades, both in the academic literature and in Washington. So I think that's the discussion that we need to have. And I think, following up on your question, I don't think that we are ever going to. No one can ever reject the rational actor model as a plausible candidate to describe the behavior of economies or individuals. So to me, it's just a matter of not rejecting the huge class of rational actor models, but simply asking, I have this model, I have that model, I have this model, which model should I use to think about the world, in the next 5 years, and not ask, is it possible to come up with a rational model that would do this? One should try to find that model, but its theoretical plausible existence is different from whether I have one in my hand right now. Yeah.
So it's just, if you look at the data, for example, the Schiller price-earning ratio you had before, there's these crazy run-ups where, for example, the dot-com or something else, but they're not always there, right? So there's quite a long quite long periods where not a lot happens. But in your model, these guys are always irrational. So what starts the craziness? What starts the actual period where the bubble gets out of control in your model?
Right. So in this model, it's not that. So one thing that we haven't done yet, but which one can use the natural forecasting function to do, is to introduce feedback whereby people not only respond to good earnings news, but also respond to good price innovations. So that's going to create, even more volatility in those asset prices. So that's one answer. But the other answer is the kind of patterns that you saw in the Campbell-Shiller data, you're going to see in our economy too. And it's just that the prices get way out of sync when there's a long series of good shocks in a row. And most of the time that doesn't occur. I mean, for example, if you had a long series of shocks that were up, down, up, down, up, down, our agents are going to end up having correct beliefs. But if you had a long series of shocks that took you up, then they're going to end up having beliefs that you're going to stay at that high level and maybe even continue. So, like Kindleberger, it's a long series of good fundamental news that can pull you way out of line in terms of the economy, and that long streak of good fundamental news, which happened in the 20s, which happened in the 90s, which happened in the housing market in the last 5 years, before 2006, that's what produces an extreme misvaluation. Yeah.
Yeah, so I think you have a very nice framework, and I think the assumption of non-rational expectations is indeed a very plausible one. But you choose a particular form, which you call natural, with great rhetoric, of course. Well, how natural is it really? So when you look at actual expectations formation, is there any evidence that they follow your natural classification? In particular, because we know that there's a sizable literature on expectations of learning in macroeconomics, and it has found that there is evidence that there is learning in expectations, like adaptive learning, and that describes expectations quite well for many survey expectations. So to what extent is natural learning closer to actual expectations formation than adaptive learning? And to what extent are your results robust to adaptive learning as been shown to have empirical support?
So that's a good question, and one thing that we are planning to do is to try to run those horse races. We haven't done that yet. One problem is we're not exactly sure. So I began to do that and try to look at expectations data that was available, and struggled a bit because there isn't a lot of it that's kind of quantifiable. There's a lot of data like, do you think the economy is going to do better or worse? But we wanted actual forecasts, and then we worried that the people who give actual forecasts tend to be blue ribbon forecasters and not the general public. And this is kind of a model of the general public. So we're not exactly sure how to test it through that channel, but we do think that it's incumbent upon us to eventually kind of go down that path and find whatever forecasting data we can and run those horse races. We just didn't do that first because we felt that information in asset prices and consumption was in some sense the best measure of what people believe, as opposed to surveys that ask people, will the economy be stronger or weaker next quarter? But we're going to do that eventually too, even if we have doubts about how to interpret it. That's what Tortorici does. He looks at that data and struggles to quantify what it means when someone says the economy is going to be stronger next quarter.
I'd hate to raise your blood pressure, but to what extent, when we think about heterogeneous agents of whatever form we've talked about here, are we just not fine-tuning a sort of von Neumann, Morgenstern world in which we have uncertainty about the probability of different states of nature? And so we're in a sense just rewriting these agents as an aggregate agent who just doesn't know the probabilities attached to different states of nature over time. And then in that world, we just can uncover or recover rational expectations, way of thinking about things. That's something you can.
So that's plausible. I could imagine going down that path and writing down a world where people had some complicated prior about what's happening in the world. They're not sure whether it's a mean reverting world or a persistent world, and they end up with some point in the middle, and they struggle to understand what's happening. And I think, part of me says that is an important piece of what's going on. We went with this because we were pretty driven by the ability to very parsimoniously capture what we feel are the key facts. But if you showed me a model like that and it worked and it didn't have a million free parameters, I would love it. So, I consider that to be, in some sense, we're all on the same page. I feel like we need something different from what we have. But whether it's a more complicated rational model, or whether it's heterogeneity with convex weights across many beliefs, or whether it's rational agents who have a complicated theory of whether the world is mean reverting or stationary, let 1,000 flowers bloom, all good, and they probably all have merit. But I just want to lay that model out and see it perform and compare it to the data. Yeah.
Well, I wouldn't like to think our tentative questions mean that we weren't stimulated by the paper. I thought it was very interesting. But I tend to think that a bubble is a bubble is a bubble. And I would like to complete the poem along Alec Cairncross's version, a trend is a trend is a trend. It seemed to me interesting, so that while Greenspan was in power, he thought he couldn't distinguish a bubble from exuberant behavior. Now, I would have thought the definition of a bubble is that it must burst. And it was interesting, after his Damascene conversion, Greenspan became a 25% man like you, or it could be 30%. We never know, but he had quite a turnaround. So I think that's all very curious. The other point that interests me a lot was the notion of rational forecasting. Now, I live in a world where I think suicide bombers are rational. And I think forecasting is forecasting is forecasting. So what in your model, maybe I should have understood this, makes a forecast rational?
In the narrow sense of the model, what makes it rational is a direct correspondence to the data generating process. But these questions emphasize the point that you could have a more general model where agents have the forecasting function that I've written down, but they have it for rational reasons. So they're not necessarily capturing the true data generating process, but their missed forecasts are rationally derived from priors about a complicated world, a world they don't yet understand. So I don't want to get into a debate, and it's my fault for using the word rationality so often, about whether these agents are rational or not rational. What I really should say is, I've offered a...
But isn't rational, in terms of rational expectations, is collective behavior, does not apply to agents. Rational expectations about the behavior of the market as a group, is it not?
Well, different people use the word to mean different things. I'm happy with either definition. I tend to use the word to mean the behavior of the individual agent, but I take your point. I mean, it's perfectly reasonable to think about an aggregate economy and not worry about the individual agent.
I think maybe you could carry on this conversation at the reception afterwards, if that's okay. But in the meantime, maybe we should thank David for his very intriguing, thought-provoking presentation. Thank you very much, As I said, there's a reception for an hour next door. I'm sure David is perfectly willing to take more direct questions.
And also emails. I'll be at the reception and love to get your feedback, and suggestions over email are very much welcome. Thank you.
Very good, thank you.
Thank you.
very
That
much.
was great. Thanks a lot.
Thank you. It's good. Thank you.
I'm going to grab my